So we went through earlier the system to help instill investor confidence, and despite that, though, there's still, unfortunately, some bad apples out there. There are a lot of amounts in financial statements that are based on judgment. And when you have judgment in estimates, you have the opportunity for manipulation. Management has the incentive to meet analysts' expectations. What I mean by that is that analysts out there watch companies closely, and they watch what's called the earnings per share. I'm going to show you that here, and you can read more about that in 6.2. But earnings per share is the net income right off your income statement, and it's divided by the shares that share in that. And that's the technically it's called the weighted average common shares outstanding, but just simply put, it's the shares of stock that are in the public's hands. So in this example, it comes out to be $2 per share when you take the net income of 8.5 million divided by the average shares that are out there, 4,250,000. Now, analysts, prior to say this earnings per share being announced to the public, it has anticipated what that number will be. And if management doesn't meet that analyst expectation, it'll have a effect on the stock price. So if they don't meet it, you'll often see the stock price fall. Even if they don't make it by much, if it's close, you'll see stock price fall. So what I want to do is scoot back up here to show you this incentive maybe for manipulating. If you look at what I have here, I have the salaries of CEOs, the compensation of CEOs, which this is per year. But what I want to show you is that a large portion is from stock options. I mentioned those earlier. Stock options, it's a form of compensation, and what it is that a company gives them this piece of paper that says that this executive has the right to turn that stock option in and get stock at a specific price, and that price is the current price. And they can turn these stock options in, but usually they have to wait a fair amount of time before they can actually turn it in. So there's some future date specified on it. So the idea behind it is that these executives have the incentive to make sure the stock price goes up, because they're going to then be able to buy these shares at this lower price. And the idea again is so that they work hard and that the company is successful and that the stock goes up. Problem is, it doesn't always work that way, and that you've got what they call moral hazard, and that executives may act in their best interest, which may not be in the best interest of the shareholders or the company over the long run. But anyways, I want to go through how some of this manipulation can occur. And for you to be aware of some of these areas. These estimates, some of them, I'm going to go through each one of them briefly. The first one is that in accounting, the accountants are required to not overstate their assets. And if you look at most companies, they have receivables on their books that some of them they're not going to collect. So they're required to make an entry. These accountants are required to reduce their assets for the amount they think they're not going to collect, and then to reduce their net income. Now, these aren't the exact entries, but I'm just wanting you to see the effect of this. Well, this is an estimate. So if there's the incentive to maximize earnings because they're not quite meeting analysts' expectations, they might make this estimate a little lower than it should be, so that their net income is a little higher. Another one is the capital expenditures. Capital expenditures basically means it's the purchase of assets. And the rule is that you can record all costs to get an asset in place and ready to use. Well, WorldCom, which was laying or building fiber optics, they had recorded as assets $6,400,000 worth of expenditures, money spent, that should have been expensed. So in other words, what should have been recorded, instead of increasing an asset, they should have reduced net income. So the idea again is that you got to watch for that abuse where they're calling what should be expensed as assets. Depreciation. Think about depreciation. You have companies, like they have to estimate the life of the asset, and they also have to estimate what they think they're going to get for that asset when they're done using it. I've got here the example, which is a true story. I believe it was Pan Am, where before it went bankrupt, well, let's say when it went bankrupt, the shareholders sued, and they were saying their financial statements didn't indicate they were going to go under. Well, what had happened was they were using 35 years to depreciate their planes, where other companies, other airlines were using just 25 years. Well, that made a significant difference, because if you depreciate, and I have an example here of a $100,000 plane, that the expense per year is a lot less than had they used 25, so that their net income was a lot higher. This is again where they've used more a bigger denominator, 35 years instead of 25 years. So it's good to look in the notes of the financial statements to see what are the lives they're using, because they have to actually disclose that in the in the notes to the financial statements. Another estimate that can be abused, if you will, is if a company has sells its goods with a warranty, they're supposed to estimate how much they think will come back and expense that. So I have that entry here. They are supposed to record what they think is going to come back from sales they've already made, and record a liability. So if depending on whether they would need to increase net income or have a higher net income to meet analysts' expectations, they can understate that estimate. Revenue is an area that's tough and could possibly be abused, where you might record things too early or too late, depending on whether you want the number to be higher or lower. And I want to get to that now. I'm going to talk about the big bath charges, because you typically think that you're going to manipulate in order to have higher net income, but that's not always the case. So if you have an accounting period where the earnings per share is not going to meet analysts' expectations on all of those estimates we were talking about, the tendency there would be to just have them be higher, have the expenses be greater than you would typically estimate, so that in the future periods your expenses would be lower, and then your net income will look better. So it's basically let's take all our charges this year, so next year and future years would look better. So unfortunately there's this manipulation, and it's unfortunately some of this is legal because it is judgment, but hopefully you have auditors that are questioning whether the amounts are conservative or not, and making management be more reasonable, and that the end result is hopefully reliable financial statements. It's not a perfect world out there, but it still works fairly well. There's bad apples, but there's still a lot of good ethical companies out there that are good investments.